Welcome back to The Deep Dive. We're the podcast that digs into those corporate conference calls so you don't have to. Today, we are really sinking our teeth into the Q1 fiscal 26 results from the global French fry giant, Lamb Weston, that's ticker LW. Our mission today, well, it's pretty straightforward. We want to analyze how they're doing on their focus to win strategy, but maybe more importantly, figure out the price tag for those impressive volume gains this quarter. Are they buying market share a bit too cheaply? And the big question, is this the quarter that confirms that major narrative shift, the move away from being a heavy capital consumer?
Yeah, it's definitely a successful quarter if you just look at the headline numbers. But like you said, it came at a cost. The market loved the beat, no doubt. But we really need to look under the hood here. Lamb Weston, they delivered solid volume growth, driven by that customer momentum. But they really had to spend pretty heavily to get it. So the real tension is that impressive, 6% volume growth versus the frankly massive pressure on their average selling price.
Right. So let's start with why the market reacted so positively. The stock jumped, over 4% right after these numbers dropped. The adjusted earnings per share, the EPS, came in at 74 cents. I mean, that's a huge beat. It just blew past the consensus estimates, which were stuck way down around 54, maybe 55 cents.
That 20-cent gap really tells a story. It's about operational discipline meeting that volume demand. But the top line, the revenue, that needs a bit more context. Revenue was basically flat at $1.659 billion, which actually translates to a slight 1% decline if you adjust for currency fluctuations.
Right. And just to pause there for listeners, when we say constant currency or CC, we just mean taking out the effects of, say, a strong or weak dollar. It lets us see how the actual business performed, operationally, without those exchange rate swings muddying the picture.
Exactly. Now, even with that flat revenue, the adjusted EBITDA, that's a key measure of operating profit. It did tick up 1%, came in at $302.2 million. But the real engine, the thing driving all that investor excitement, it wasn't really profit growth, it was volume. We saw a really robust 6% volume increase. That reflects good customer retention, some new wins, particularly strong in North America and Asia.
Okay, 6% volume growth is great. That shows real commercial momentum, like you said. But wait, if volume is up 6% and revenue is flat? Well, they must have had to drop prices pretty dramatically to win that business. So let's talk about the other side of that coin, the price mix impact.
You absolutely hit the tension right on the head there. To get that momentum, the price mix factor, it was down 7% on a constant currency basis. And that decline, it's not just random. It reflects those carryover trade investments from last year, ongoing customer support they're providing, and also, frankly, an unfavorable product mix that just dragged the average selling price down.
So they were essentially sacrificing margin to keep those factories humming. And we see this playing out directly in North America, right? Adjusted EBITDA there actually declined by $18 million. And it seems like that entire drop was basically down to those price concessions and trade investments they made to, secure and grow the customer base. Is management okay with selling that much product, that cheaply?
Well, management's view, I think, is that they needed to lock in that foundational volume, especially while they're simultaneously executing on the cost cuts, which brings us to the Focus to Win program. Now, if we look internationally, adjusted EBITDA there rose $5.8 million. But that's a perfect example of what we call lapping.
Right, lapping. For the listener, that just means the comparison year, the year before, had some bad news that isn't there this year, correct?
Exactly. We're comparing this quarter to Q1 last year when they had a pretty significant one-time charge. It was related to a voluntary product withdrawal. So that charge is gone this year, which automatically makes the comparison look better. So while the international operational story is definitely strong, that segment's profit boost is partly just, an easier comparison, not necessarily all new operating strength this quarter.
Okay, so if we accept they had to pay up, let's say, for that volume growth, let's talk about the countermeasure, that Focus to Win strategy. This is their big multi-year cost savings program. It's really the backbone of the longer-term investment story. They're targeting, a minimum of $250 million in run rate savings by the end of fiscal 28. Are they actually making progress?
They are. And the near-term targets are pretty aggressive, too. They're looking for at least $100 million in savings, plus another $60 million in working capital gains by the end of FY26 alone. And you can see they're working on it because this quarter, Q1, they recorded about $32 million in charges related to the program, which basically means they're actively spending money now on restructuring, things like that, to get those longer-term efficiencies.
And what's really interesting is how their operations seem to be backing up that volume story. To keep up with demand, to maintain those customer fill rates, they're actually restarting a North American production line in Q2, one they had previously shut down. I mean, that's a pretty big operational signal that this 6% volume momentum feels sustained to them.
Yeah, definitely. And on the international front, that new facility in Argentina is now up and running, operational. They did have about $4 million in startup costs hit this quarter, which is pretty typical for a major facility launch like this. What's really critical there is that 80% of the production from Argentina is actually destined for export, mainly going to markets like Brazil. But expect that utilization ramp up to take some time. It's definitely a marathon, not a sprint, to get that fully efficient.
Okay, let's pivot a bit to the capital efficiency story, because I think this is maybe the most exciting long-term driver here. Input costs seem favorable. We're apparently expecting a mid-single-digit percentage decrease in North American potato contract prices starting late in Q2. That's good news.
Yeah, lower potato costs is definitely helpful. But the really big news, I think, is the capital expenditure step down, the CapEx. Think of it like this. They just finished building this big, expensive house, right? And now they're just paying the regular maintenance and utility bills, which are obviously far cheaper than paying the construction crew every month. Cash from operations was strong, $352 million, helped by those working capital gains, lower inventories. But the Q1 CapEx number dropped significantly, down to just $79 million.
$79 million? Wow. That is a massive shift compared to recent years. So their major growth expansion projects like that Argentina facility we mentioned, they're pretty much done now.
Yeah.
Completed. Exactly. And the full year FY26 CapEx guidance reflects this. It's guided at roughly $500 million, which, still sounds like a big number, but it's heavily weighted towards just essential maintenance, modernization, environmental projects, things you have to do. So this completion of the major growth bills, it really marks a critical inflection point for the balance sheet. Lamb Weston is shifting pretty dramatically from being a capital consumer to becoming a potentially massive cash generator.
Okay, so despite that strong Q1 beat, especially on EPS, management decided to just reaffirm the full-year outlook for FY26. Net sales guidance stays at $6.35 to $6.55 billion, adjusted EBITDA between $1.0 and $1.2 billion. Why not raise the guide after such a strong start? Seems a bit conservative, maybe. Yeah, it signals prudence, I think. They're clearly managing expectations around those near-term headwinds we talked about. They explicitly said they expect price mix to decrease mid to high single digits in the first half of the year, so Q1 to Q2. But that pressure should moderate quite a bit in the second half, mainly because they'll start lapping those big prior year price actions we discussed earlier. The comparisons get easier.
Got it. And there's a critical nuance for Q2 specifically, right? Management expects the gross profit margin in Q2 to be basically flat with Q1. Why wouldn't it improve if those potato costs are starting to come down?
It's really about timing and some temporary pressures in specific segments. You've still got those Argentina startup costs rolling through. They mentioned longer planned maintenance downtime in some other factories during Q2. And crucially, in North America, some other inflation is expected to tick up slightly before the full benefit of those cheaper potato contracts really hits the P&L later in the quarter. So it's basically just a delay in seeing the full good news flow through to the margin line.
Okay, that makes sense. And we also got a couple of new financial details for investors this quarter. First, the full year guidance now officially incorporates about a $25 million annualized hit related to tariffs. Is that right? On palm oil and other stuff?
That's right. Primarily from Indonesia and Malaysia. That's a new disclosure. Wasn't explicitly in the guide before, so it impacts the baseline expectations going forward. And separately, they also tweaked the tax rate guidance. It's slightly higher for the full year now, moving up to 26-27%. And they noted the first half, so Q1 and Q2, will likely be higher, somewhere in the low 30s.
Okay. And finally, before we get to our trade idea, let's touch on that commercial strategy shift in North America. They're adding a broker model to their sales approach to go after what they called underpenetrated channels. But the core direct sales force is staying, focusing on the high-value accounts.
Yeah, this makes a lot of sense strategically, because the underlying demand structurally is still healthy. Think about the fries attachment rate, how often people add fries to their order. It's still running about 2 percentage points higher than before the pandemic. That's significant. Now, overall QSR traffic was kind of flat this quarter. Burger chains were down a bit, chicken chains were up, but the overall market for fries seems stable. So LW's goal here seems pretty clear. Use this new broker model to grab more market share in places they weren't reaching effectively before. while at the same time relying on that Focus to Win program to drive the operational leverage and improve profitability on that volume.
They're still committed to capital return. Returned $62 million to shareholders in Q1, mostly dividends, 52 plus $10 in share buybacks. And they still have, about $348 million left on the current buyback authorization.
Which sets us up nicely for the next segment.
All right. Time for our favorite segment. This is not financial advice.
Sure.
What's the outrageous but plausible trade idea this time?
Okay, so for our theoretical trade committee pitch today, we're circling right back to that core insight we've been discussing, which is the company has, arguably, successfully made the turn. They've transitioned from being a heavy capital consumer to becoming a phenomenal cash generator. And our thesis is that the market is currently underpricing just how quickly that free cash flow, the FCF yield, is going to ramp up over the next, say, 18 months.
Okay, so the market hasn't fully appreciated the impact of that CapEx drop yet.
Exactly. With those major CapEx builds pretty much complete and those working capital targets starting to hit, the actual FCF number, the cash left over after all expenses and investments, it's poised to accelerate dramatically. So we're essentially betting on the stock price going up as that FCF yield improves. And we think that improvement will inevitably create, frankly, massive pressure on management to accelerate shareholder returns. We wouldn't be surprised to see them announce a much larger share repurchase program sometime soon, something far exceeding that current $348 million authorization.
All right, so how do you structure the trade around that thesis?
So the strategy we'd propose is to establish a long position in the stock itself, just buy the shares. But combine that with selling an out-of-the-money put option. Selling that put helps capitalize on the current implied volatility in the options market, and it effectively creates a structure where you're betting that the combination of cost savings execution and that FCF generation will put a solid floor under the stock price, while the potential for a big capital return announcement driven by that FCF provides the real upside momentum. We're betting on the balance sheet leverage dropping fast and that FCF lever getting pulled really hard really soon.
That FCF acceleration thesis is definitely compelling. It's grounded right in that huge step down in CapEx, which is hard to argue with. But, the market tends to sniff out operational slowdowns pretty quickly. What if that new broker expansion model takes longer to gain traction than they hope? Or maybe the Focus to Win savings come in a bit slower than planned? Couldn't that delay the FCF payoff, leaving investors kind of stuck waiting? That seems like the key execution risk here, doesn't it?
Oh, it absolutely is. Execution risk is always there, no question. But the core foundation the factories have built, the structural demand, seems pretty steady. That makes this feel like a reasonably high probability scenario, even with those risks.
Okay, interesting. So to wrap up this deep dive then, Lamb Weston delivered a strong volume quarter, proved they have commercial momentum. They seem to be navigating the execution phase of Focus to Win pretty well so far. And they gave us a clear path to stability by reaffirming that full-year guide, even while acknowledging those near-term price and mix headwinds.
Yeah, the path forward seems pretty clear. It's all about volume growth now being fueled by increasing operational efficiency. So the final question, really, for you, the listener, to think about is how effectively and how quickly will that move to expand the sales model using brokers in North America actually penetrate those new markets? Because the speed of that market share gain is probably what's going to determine how quickly they can finally overcome these stubborn price pressures and really start to leverage that accelerating free cash flow we've been talking about.
A fascinating dive indeed. As always, please remember this discussion is purely for informational purposes. It definitely does not constitute investment advice. Thanks for diving deep with us today. We'll catch you on the next one.